Welcome back. Today, we're going to break down a really detailed investor analysis of one of Canada's biggest banks, the Canadian Imperial Bank of Commerce, or CIBC for short. We're going to follow along and see exactly how this analyst picks it apart piece by piece. So, everything in this deep dive really comes down to this one single question. Right now, today, is CIBC a smart place to put your money? We're going to follow the analyst's entire thought process to see how they got to an answer. Okay, let's get into it. Here's our roadmap for today. We'll start with a quick look at what CIBC actually does. Then we'll try to figure out what it's really worth. After that, we'll go deep into the bank's financial health, check out the risks and rewards, and then, the big one, we'll pinpoint the exact price that this analyst thinks is a buy. First things first, let's just get a really clear picture of what kind of business we're dealing with here. What is CIBC, and how does it actually make money? Well, the analyst paints a picture of a classic, old-school bank. It makes money from interest on loans and mortgages, plus fees from things like wealth management. The key thing to understand is that it's what you call a mature, dividend-paying company. But, and this is a big but, it's also super sensitive to the economy, especially things like the housing market and interest rate changes. All right, let's get to the numbers. How does an analyst even begin to figure out what a single share of CIBC should actually be worth? Its intrinsic value. Okay, and this part is absolutely crucial. You have to understand this because the entire analysis is seen through this one specific lens, a goal of making 9% per year, every year for 16 years. That specific target is the yardstick that every other number gets measured against. So the first method up is a discounted cash flow model, or a DCF. Basically, it tries to predict all the future cash the company will make, and then figures out what that's worth in today's money. Using that model, the analyst gets to an intrinsic value of 128 Canadian dollars a share. But hey, one model is never enough, right? So the second method is called the margin of equity model. This one looks at the company from a totally different angle. It focuses more on its assets, its book value, and how well it turns those assets into profit. And this method gives a slightly higher number, coming in at $145. Now, this is where it gets really, really interesting. You put it all together. We've got our two valuations, 128 on the low end, 145 on the high end, and just look at where the market price was at the time, about $139, smack dab in the middle. Right away, that tells you this stock probably isn't a massive bargain, but it's not crazy expensive either. It seems, well, fairly priced. Okay, so the valuation seems to be in a reasonable range, but is the actual business healthy enough to back that up? Time to go a little deeper. And on the surface, things look pretty good. The profitability numbers are strong. A return on equity close to 15%. That shows the bank is really efficient with its money. And that recent growth in both revenue and earnings is nothing to sneeze at, probably helped by what was happening with interest rates at the time. But, of course, the analysis doesn't just look at the good stuff. It also scans for potential red flags. Now, that negative cash flow, that's actually pretty normal for how banks do their accounting, so it's not a huge worry. The real concerns here are its high sensitivity to the overall economy and, most importantly, its massive exposure to the Canadian housing market. That's a big risk that gets called out. So, what about the people steering the ship? Well, management gets a pretty solid grade. They're described as competent, conservative, and focused on exactly what you'd want them to be, paying out a reliable dividend and aiming for steady, predictable growth. No major concerns there. All right, next up, the analysis takes all these different pieces and starts weighing the good against the bad. And then it maps out a few different ways the future could play out for the bank. So this isn't just a simple pros and cons list. It's a weighted analysis. Each factor gets a score, but it's also weighted by how important it is. You do all the math, and CIBC ends up with a score of 6.85 out of 10. So what does that mean? It suggests a pretty balanced outlook. Positive, but just modestly. The good stuff doesn't totally blow the bad stuff out of the water. And this is a brilliant way to show the range of possibilities. In a tough economy, that's the bear case, the analyst thinks the stock's value could drop to about $100. But in a really strong economy, the bull case, it could shoot up to $165. The base case, or the most likely scenario, lands at $135, which, again, is super close to the market price. It just goes to show how tied this bank's future is to the economy. So this brings us to the most important part, right? After all this work, what's the magic number? At what price does it actually make sense to pull the trigger, especially if you want to hit that 9% return goal? And here it is. This chart is basically the whole payoff. Remember that 9% annual return goal we talked about at the beginning? Well, to have a good shot at hitting that over 16 years, the analysis concludes you can't pay the current market price. You'd need to get in at or below $110. That's a pretty big discount from where the stock was trading. The analysis gets even more specific, though, by factoring in your time horizon. To get that same 9% return, if you only plan to hold for 5 years, you could pay a little more, up to $120. But if you're in it for the long haul, 16 years, you need an even better entry price, around $105, to really let that compounding do its thing.
And finally, the analyst boils everything down into 2 simple scores. The risk score is a 6.7 out of 10, so, moderate risk. And the opportunity score is a 6.9. Again, moderate opportunity. Look how close those are. It really hammers home that this is a balanced situation, not one where the reward hugely outweighs the risk or vice versa.
Okay, let's bring it all home and see what the analyst's final actionable conclusion is after all of that work. And there it is, plain and simple. After all that analysis, the verdict isn't a buy and it's not a sell, it's a hold. The takeaway is that CIBC is a solid, stable bank, but at its current price, it's pretty much fairly valued. The only time it becomes a truly attractive investment based on that 9% goal is if the price takes a tumble down to $110, giving you that critical margin of safety. So that's our deep dive into the investment case for CIBC from top to bottom. It's just a fantastic example of a really disciplined, goal-focused way to look at a stock. Now, I want to hear from you. What company should we put under the microscope next time? Drop your suggestions in the comments below.